Okay, I think we'll make a start and still see a few more people attending, but we will make this recording available following the presentation as well. So we'll make sure that everybody doesn't either have the chance to attend or hasn't dialed in. If you can pass on the message that we will be making this information available. Firstly, thank you very much for attending the latest half-yearly DEWS investment update presentation. We're going to aim to cover the investment content during the next 30 minutes, which will leave us time at the end to answer any questions that you may have. Now, the questions can be asked during the course of the presentation through the Q&A section on your Teams access. We'll try and actually answer those questions if we can during the presentation to give you live feedback. It might be that we take some of those questions back and we'll build them into our Q&As, which also we will distribute once available. Just by way of an introduction, my name's Chris Kane and I represent Equium. Equium are the master trustee of the DEWS plan, and I'm delighted to be joined by representatives of our DEWS partners, Mercer and Zurich. So I start initially with the team from Mercer. We've got Asad Hussain, Nora O'Connell and Julius Bendicus, and they will be talking through the investment related elements of the presentation. For those that don't know Mercer, they're the appointed investment advisor for DEWS, and from a stature position, they are deemed the largest investment consultant globally, and they advise on over $17 trillion of institutional investor assets. And then from Zurich Workplace Solutions, we have Daniel Lewis, and Daniel will be facilitating the question and answer section at the end of today's session. Zurich, again, from a stature position, are the leading provider of employer-sponsored pensions and savings arrangements in the Middle East, and they use that experience as the appointed administrator for DEWS. And Daniel's role in the overall relationship, he manages the day-to-day relationships with our key partnerships or key partners in DEWS. It's great to have him on the call today. Over the course of the next 30 minutes, what we'd like to cover off, as was outlined in the introduction or in the invitation, is an overview of the investment. So we'll talk through the DEWS investment range, so the options that are available for you to select as members. We'll build in a market update, so we'll talk about what's happening in the market and what we see coming. Then we'll dive a little bit further into the investment options. We'll talk about the performance and the potential outlook, and then cover off some investment guiding principles. We hope that the information that we cover is useful for you. Please bear in mind we are covering a wide range of investment knowledge, so there will be some things that you might find useful, some things that you don't, but hopefully during a short section of 30 minutes, the information you'll find useful. As I mentioned at the end, we have a time for Q&A. Please drop those Q&As into the section on MS Teams. We'll try to answer them live. We'll try and answer them at the end, and it might be that we have to take some away and respond separately. Just before we start talking through the investment update, what I thought it would be worthwhile doing, and we've done in previous sessions, is to just cover off the DEWS operating model, and that's shown on the screen in front of you here. The operating model was designed by a working group of industry experts, and it includes three main segregated roles. And those three roles are a master trustee or operator, and that role is performed by Equium, so that's the business that I represent. Then we have an administrator role, and that's performed by Zurich Workplace Solutions. And then we have an investment advisor role, and that role is performed by Mercer. Now, each of those companies is considered or would be considered the market leader in their particular role, or their industry, and each were appointed through competitive RFP process back in 2019. And the three companies come together to form the DEWS plan that you're all part of. As an added layer of protection, and really importantly from an oversight perspective, the plan has an independent supervisory board, and that was created at outset. And the main purpose of the supervisory board is to ensure that the three appointed providers, Equium, Zurich and Mercer, as I previously mentioned, are carrying out their roles efficiently and correctly. And the way that we report on that, we come together on a quarterly basis to meet with the supervisory board to talk to them about what we've been doing and what we see coming as well, to allow them to understand and feedback to us. What I'd like to do now is move on to the investment section, so I can hand over to Asad, Nora and Julius, who will talk us through the investment update. Thank you.
Great. Thank you very much, Chris. Good afternoon, everyone. As Chris mentioned, I'm an investment consultant in Mercer's wealth team based here in our Dubai office. Thank you all very much for your time this afternoon. To start with, we thought it would just be useful to provide an overview of the investment options that are available to you. So as many of you might know, when your contributions are paid into the DEWS plan, the money then gets invested into one or more investment options. The aim of these investment options is to make the money work for you and generate returns and help you meet your savings goals. We know that members have different investment needs, different time horizons, different attitudes to risk. So we offer a range of 10 investment options that's currently provided that you can choose between. Just to describe the chart, it shows the expected long-term risk and expected return characteristics of each of the investment options. On the horizontal axis, you have the expected risk or volatility, starting from the left-hand side, which are the low risk options, going to the right-hand side, which are the high risk options. And similarly, on the vertical axis, you have expected returns. So starting at the bottom with the lower expected returns and moving towards the top with the higher expected returns. There's 7 conventional investment options that you can choose from that are shown in blue on this chart. And there's also 3 Sharia compliant investment options that are shown in purple. And those are for members that want to invest in line with Islamic religious beliefs. On the bottom left-hand side, you have the defensive options like the low growth and Islamic money market option. These aim to provide capital preservation before fees. Moving towards the upper right-hand side of that chart, you have the higher expected risk and higher expected return options, including the high growth option, the passive global equity option, and the Islamic global equity option. If you don't make any investment choice, your money automatically gets invested in the default investment option, and that's the low moderate growth option that's shown towards the middle of that chart. Each of these investment options is carefully selected by the trustee after taking advice from Mercer. And you can invest in one or more than one of these options. So for example, you can split your holdings 50% between one option and 50% in the other option. You can also switch between options at any time. But I think it's important to note that returns are not guaranteed. So returns will rise and fall based on market performance. And the more risk you take, the higher return you can expect, but also the more volatile those returns can be. And higher risk can also expose you to higher falls in the value of your investments. So you should be aware of that. Later in the presentation, Nora will also share some more detail on the resources that are available to you, where you can find more information on all of these investment options. Just moving on to the next slide, we have a chart that shows the mix of different assets that sit underneath each of the multi-asset investment options. So the underlying asset classes include a mix of defensive assets, so things like cash and defensive fixed income, growth asset classes like equities, listed real estate, and growth fixed income. And there's also diversifiers like alternatives and commodities. As you move up the risk spectrum, so from the left-hand side to the right-hand side of this chart, the allocations to the growth assets increases and the allocation to the defensive type assets reduces. Again, I think Nora will provide a bit more detail on the asset allocation weights and how these options are managed later on in the presentation. Just to point out, the default option, again, is the low moderate growth option. So the second option, second bar within that chart, and that includes a balanced mix of growth and defensive components. One thing you might notice is that the default is deliberately a little bit more conservative than what you might expect for default options in pension plans and retirement plans in other regions. And the reason for that is that within DEWS, members can access their money when they leave employment. So the investment time horizon is usually shorter than that of a typical pension or retirement plan. And that's why the default option is slightly more conservative. All of these options are professionally managed. And on the right-hand side, you can see a subset of the sub-investment managers within each of these multi-asset options. All of these managers are highly rated by Mercer. And the trustee also regularly reviews the performance of all of the investment options within the plan's investment range and the suitability of the fund range on an ongoing basis. So I think with that, I'll hand over to Julius next. Julius is our European Head of Economics and Dynamic Asset Allocation, and he'll be able to take you through the recent market backdrop and our outlook for 2024 as well. Julius, over to you, please.
Good afternoon, everyone. So let's kick it off. First of all, I'll recap the 2023 economic backdrop. Then we'll dive into what the markets did, than what we think is going to happen for the macro and the markets in 2024. So on the top left, the key point is that 2023 was really characterized by global economic resilience. And a lot of that resilience was driven by the US. And the blue bars illustrate the quarterly growth for the US economy. As you can see, the bars are above 2% for most of the quarters, and the third quarter being particularly strong. And the reason US was so strong is because consumption was very strong. And the reason consumption was so strong is because income growth was very strong and people had a lot of savings to use. And that truly manifested in strong retail sales growth numbers and therefore GDP being well supported. Now, in comparison, other parts of the world didn't do as well. China struggled on a relative basis, and other economies like Eurozone and UK also didn't have as strong growth numbers. So throughout 2023, you could argue that the US economy overheated further, while other parts of the world remained much less overheated. So that's how I would characterize 2023. Now, also throughout the year, inflation has come down a lot, and the top right chart illustrates that. The reason inflation went down is really threefold. You had commodity prices falling, you had anything linked to disrupted supply chains broadly returning back to normal, which has created a price pressure the other way. If you think about the cost of shipping, that was 10 times the normal back in 2021, 2022, and it's come back all the way to almost normal right now. So to no surprise, when you look at the inflation rates, they've come back from being very high to almost back to where they're supposed to be, or where the central bank wants them to be. Now, another thing that happened in 2023 is that wage growth continued to run a bit too high, but it has made some progress in terms of coming down. So in terms of its impact on inflation, it's beginning to be a little bit less pronounced. And last but not least, on the bottom right, 2023 saw central banks still hiking rates a little bit, but then pausing. And as we stand now, they're still on the pause. So if we move to the next slide, against the backdrop of what I've just described, which is resilient growth and falling inflation and central banks stopping the rate hiking cycle, bonds were actually quite happy. If you look at the top left chart, this is an index that captures the performance of global aggregate bond market. And because of the lower inflation that we've seen at the end of last year, and central banks beginning to discuss rate cuts, bonds have had a really good time. So that index in the 2-month period together has had the best return since the launch of the index 35 years ago or so. So quite a big move. And another way to illustrate that is just to look at the bond yield for the US 10-year government bond at the top right, which you can see the bond yields have dropped from roughly 5% to below 4% in the last couple of months of the year. So naturally, the fixed income assets have had a very good time. And on the bottom left, another thing that's really happened in the markets throughout the year, and particularly in the last couple of months, is the strength in equities. And the reason equities were so strong is really twofold. Number one is all to do with the outperformance of US tech and the strong Magnificent Seven driving the global equity returns. And as you can see in the red line, the Magnificent Seven, the sort of the big tech companies of the US have returned north of 100% over the last year or so, whereas other equity markets have struggled on a relative basis. But over the last 2 months of the year, because of the fall in bond yields and indeed quite resilient earnings, equities did very well. So that's what the markets did. It was a volatile year, but it ended net very positive for equity markets and somewhat mixed for the bond markets, with early parts of the year seeing a sell-off, and then a lot of that was reclaimed back by the rally into the year end. So if we move to the next slide, in terms of the outlook for them from the macroeconomic perspective, we expect those economies that are overheated to slow down, and those economies that remain, we'll call it underheated, to do a bit better. So US economy should go through a period of softer activity, but I appreciate there are upside risks to that. And countries like China should do a bit better because policy stimulus there's been a lot of that, and we think that's going to put them on the front foot as we go through the year. But broadly, global economy should remain resilient, but perhaps that resilience is going to be driven by other countries than the US. Now, as far as the inflation dynamic is concerned, as I said, it's come down, and now we're walking the last mile of getting inflation back to where it's supposed to be. And I think the final mile is all to do with the wage growth and the labor market cooling. And as it stands, labor markets have been cooling, but there's still a little bit more to do. So as we go through 2024, we expect labor markets to continue cooling and wage growth continuing to move lower, and that would remove the final pressure of inflation and help it return to where it's supposed to be. Which brings me to the point on the bottom left, is that central banks, the Fed and others, are now in a wait and see mode, but I think fairly soon they will be able to cut rates because there's going to be decisive evidence that labor markets have cooled and that inflation problem is broadly resolved. Now, on the bottom right, I do note that emerging market central banks have started the process of hiking rates earlier, and they gotten ahead of the inflation more so than developed. So now they're able to cut rates a bit earlier, and they have been doing that, and we expect that to continue in 2024. So by way of summary for the outlook on macro into 2024 is that global resilience, but different as far as growth is concerned. Inflation walking the final mile, and I think we'll succeed there. But I appreciate there's some upside risks to that, particularly if the economy remains strong. And central banks are in developed world, wait and see, but almost cut, and emerging world continue to cut and likely broaden the cuts amongst different countries as we go through the year. Now, what does this mean from the asset allocation perspective, from a dynamic standpoint? Well, these bubbles say it all. Basically, we like EM because of the China stimulus, and other ex-China EMs are benefiting from an encouraging monetary cycle. We like frontier markets debt, which isn't particularly relevant for your plan, but I would just want to illustrate that emerging market debt and equities are broadly attractive from our perspective. We like Japan, we like the yen. We think both are cheap and both are interesting, and the Japanese story has room to run in terms of economic recovery, in terms of inflation picking up, and in terms of Bank of Japan likely hiking rates. We still like equities a little bit, but not too much, so we have a modest overweight. We like REITs, real estate investment trusts, which appear attractively valued. We like Asia high yield, which is again appears quite attractively valued. And we fund these overweight positions a little bit from global high yield, where we're not too excited by the spreads, and cash and cash-like instruments such as short duration bond funds, absolute return fixed income funds, or just outright cash if it exists in strategic asset allocation. So that's how I translate what I believe for the macro in terms of the market views, and a lot of that filters into the portfolios that we run. So very welcome any questions, but perhaps in the interest of time, I pass on to my colleague, Nora, to take this conversation forward.
Thanks, Julius. And in this section, I suppose we'll just put a bit more colour in terms of what Julius had talked about in terms of looking at the asset allocation of each of your investment options and their performance. So I suppose, as Asad explained, a wide range of investment options are available to cater for the different risk and return objectives of members. But just given the time available today, I'll focus on the low moderate growth option, which is where the majority of plan assets are invested. And it's also the default option for members who don't make an investment selection. So this first slide summarises how the asset allocation for each of your options is determined by our multi-asset portfolio management fund team. And the starting point is the investment objective of the fund. So for the low moderate growth option, this is a return of 2 to 3% per annum ahead of cash over the medium to long term. And it also has an ESG objective, as noted on the slide there. When setting the asset allocation, the key driver of the returns is the strategic asset allocation, so the long-term asset allocation, which is the diversified range of asset classes, which is expected to best position the fund to meet its long-term objective. This is reviewed on at least an annual basis and updated to reflect Mercer's global investment strategy best thinking. And the 2024 review of the strategic asset allocation is actually currently ongoing. As Julius mentioned, then there's also dynamic asset allocation tilts, which are shorter term adjustments to the long-term asset allocation to capitalize on market inefficiencies or mispricing and look to add incremental return in a risk-controlled way. So those dynamic tilts, overweight asset classes which are expected to outperform and underweight asset classes which are expected to underperform. And we do have a little bit of active management in the funds as well, where active management is expected to add value. So the next slide then shows, I suppose, the actual allocation of the low moderate growth option, and specifically the multi-asset sleeve, which makes up 65% of the low moderate growth option as at the 31st of December 2023. So the blue lines are the strategic asset allocation, and then the pink is the dynamic, the shorter term dynamic tilts around that. So as you can see, the multi-asset sleeve is very well diversified across and within asset classes. Given the growth objective of the low moderate growth option, it's primarily invested in equities and other growth assets such as emerging market debt, global high yield, but it also includes allocations to things like bonds and alternative strategies and cash for diversification and downside protection. The dynamic tilts, as Julius mentioned, are currently slightly overweight equities, driven by overweights to emerging markets and Japan, which are partially offset by underweights in multi-factor equity, sustainable equity, and low volatility. There's also positive tilts to REITs, to emerging market debt, to Asia high yield, and global inflation-linked bonds, and as Julius mentioned, underweights in cash and cash-like areas. So I suppose this shows you for the low moderate growth option, but each of the other multi-asset options would be very similar with this. And the higher the longer term return objective for the option, the more it will have invested in equities and other growth assets. And I suppose that's important to bear in mind when you're looking at the performance of the funds as well, as that will be largely driven by the performance of the asset classes in which each investment option is invested. So looking at performance then on the next slide, this chart shows the cumulative performance of the multi-asset sleeve of the low moderate growth option over periods to the end of December 2023. So the cumulative return is shown from 2011 to 31st December 2023 in the blue line, and then the cumulative return on cash, just cash over the same period, is shown in pink, and the long-term return objective for the multi-asset sleeve, which is cash plus 3% per annum, is shown in green. So what you can see there is over the complete period, the blue line is ahead of the green, so the fund is ahead of its return objective. Now, there will be periods, because I suppose the fund is primarily invested in equities. It's not immune to volatility on equity markets. So performance was impacted in periods where equity markets went through more difficult periods. Say, for example, there, as you can see, in March 2020. However, the diversification of the fund did provide protection against that equity market volatility, and as you can see over the full period, the cumulative return is ahead of the cash plus 3% per annum return objective. Moving to the next slide then, The box in pink shows the 1 year return to the 29th of February, so 6.8% return from the low moderate growth option for the 1 year to the end of February. So strong positive return over the period, and it primarily reflects the strong equity market returns over the year, and most asset classes provided positive returns over the last year overall. Since inception, in the green box, the return was 21.1% since launch to the 29th of February, so well ahead of the long-term return objective for the low moderate growth option. So that's a return of 5% per annum over the period since inception. Just on the next slide then, what we can see is the added value from dynamic asset allocation tilts. And looking at the blue bars, this shows you the calendar year added value from dynamic asset allocation tilts. As you can see, the added value can vary from year to year depending on the opportunities available, but it's positive in 8 of the 11 years that are reviewed here. And you can see then from the green line, the cumulative added value from dynamic asset allocation tilts over the period from 2013 onwards. So strong added value from dynamic asset allocation tilts. The next slide then shows each of the other performance of each of the other options available to you. I'm conscious there's an awful lot of information on this slide, so I don't propose to go through it. But maybe to pick out two columns. One is the third column in from the left, which is the returns since launch for each of your investment options, and then the last on the right hand side, which shows you the 2023 calendar year returns. And returns on this slide are net of fees. An important point to note is that what you see here are the returns from your investment options, and members' actual performance may differ significantly from this, as the returns from each member will depend on the dates when your contributions are invested. So I suppose, just given time, I won't dwell on this slide today, but the returns for all your options are there for you to look through. In terms of additional investment resources, your investment guide, fund fact sheets, and a wealth of additional information is available on the website, and the fund fact sheets are updated on a monthly basis. So they provide much more information on the strategy, performance, and asset allocation. And we'd strongly suggest that you take a look at those and get more information on your options. Moving on to the next section then, just finishing with some investing guiding principles. So first and foremost, we'd caution against trying to time markets. It's incredibly difficult to do and carries a significant risk that badly timed investment changes lock in losses or miss market recoveries. So to help illustrate this slide shows the annual returns on various asset classes over the last 10 or so years, and global equity returns are highlighted as being one of the top performers in 2023, but you can see there the variability that there has been in returns from year to year. And there are 4 questions, I suppose, on the next slide that really we would suggest that you consider when making your investment selection. So what's your attitude to investment risk? How long do you expect to invest your savings? The more comfortable you are, I suppose, with investment risk, the more potential you have to move to invest in higher growth options. The longer you have to invest your savings, similarly, the more you could potentially to invest in growth options. How do you plan to use your savings, and another key consideration, and what are your personal circumstances and financial situations? If say, for example, you have additional savings elsewhere, this may influence the investment decisions that you take in this plan. On the next slide then, some guiding principles, do's and don'ts. So Make sure you understand, your investment choices, your savings objectives, know where to access information as outlined previously. View your savings as a long-term investment and regularly check to see where your investments, how your investments are performing. But we don't try to time markets, as I mentioned. The next slide just gives us an amplified example of how poorly timed changes can lock in losses. We have a member here who was invested in growth assets, saw those growth assets underperforming, decided to move to conservative options and missed a bounce in markets as a result. So unfortunately, this simplified example just illustrates how easy it is to make a decision based on short-term performance and then unfortunately lock in losses, which is not ideal. So I suppose I know that this presentation has been quite short this morning, but I suppose we might just pass it back to Sad now to open the floor to questions. And I suppose no action is required as a result of this presentation, but you may wish to check where your savings are invested, make sure it remains appropriate. Do consider the investment guiding principles that I just outlined there. Yeah, if you have, I might pass it back to Sad now if you have any questions on any of the items covered.
Great, thank you so much, Nora. That was really useful. I think just before we move on to the questions, I just wanted to highlight this slide that includes contact information for Zurich. So if you have any questions or if you have any concerns, you can give them a call or an email and just reach out to them with your questions, and they'll aim to come back to you as soon as possible. There's also a link, a QR code here for an app that you can download, just to make sure that you download the app and make sure that you have access to all of the information that's provided there. So with that, I think I'll hand over to Daniel to take us through the questions that have been coming in. Daniel?
You're on mute, Daniel.
Sorry, everyone. Yeah, thank you, Asad. In the interest of time, I think we just get straight into the questions. So the first one for Chris. How can I get advice on which investment option is right for me?
Okay, thanks, Daniel. So I would say probably initially, I would recommend reading the literature, the plan literature that we make available on the website. There's a lot of information in there that help you make an investment, or should help you understand the range to help then give you an idea in terms of which investment choice is right for you. I think, again, attending a session like today where you're understanding more, and Nora talked about the fundamentals of choosing the right option based on risk and return and your personal position. I think from our perspective, what we've tried to do when we've designed DEWS and the investment range in particular is to make it as easy as possible for members to make their decisions. So we've brought in risk-rated options, which should give you a feel for how you're investing and what level of risk and return you're accessing. I always find it useful as well to reach out to friends and colleagues and family members who may have the necessary information, and there's always the regulated investment advisors in the DFSA and the wider the UAE who specialise in understanding your requirements to help then give you the right decision. If you do decide to change your investments, you can do so through your online access. It's free of charge to switch your investments. You can switch as often as you like. There's no limitations. However, it's not recommended to be switching too frequently, again, as Nora highlighted. And I think when you come to think about it, and if there's any doubt, reach out to the Zurich team for support. They're not licensed to provide advice, but they're always very helpful in pointing you in the right direction, and maybe could provide some more information about getting in touch with the relevant experts.
Great, thanks, Chris. Next question. Is there a fixed income option within the plan? I think Asad.
Sure. Thanks, Daniel. Yes, there are fixed income options within the plan. So at the lower end of the risk scale on the chart that I showed earlier, there's a couple of money market options. There's a conventional US dollar cash option and also a Sharia compliant Islamic money market option. And those options aim to provide capital preservation before fees. And then slightly higher up the risk spectrum from that, there's a global defensive bond fund, which is a fixed income option that was introduced into the plan in 2022, and it invests in short-dated government and corporate bonds. And then members also have access to a global sukuk option, which is again slightly higher up the risk spectrum from that. And that invests in Sharia-compliant debt with slightly longer average maturity and duration than the global defensive bond fund.
Thank you. Next question. Are the portfolios managed actively or passively? I think one for Nora.
Yeah, so we will use active management where it makes sense to do so. So in less efficient markets where we can add value net of fees through active management. So things like Asia high yield, the short duration bonds, liquid alternatives, they're all actively managed. For them, I suppose, so there definitely are areas where we will use active management, but for the most part, to keep fees competitive as well for members, the majority of the assets are typically passively managed. So a mix as it's appropriate.
Okay, thank you. What happens when I leave my employer? I think I can answer that one. So when you leave your employer, there are 3 options available to you. One is you can absolutely stay invested. Maybe the market's doing particularly well and you're seeing some gains, or maybe even the market's a little down and you need some time for it to come back. So you can stay invested. The other option is taking a partial withdrawal. And finally, you can take a full withdrawal, of course, and that can be straight away as soon as you leave. And we'll aim to have that money with you within 7 to 10 working days. Or perhaps if you move to another country, you would just get in contact with us. We would take some identification documents, etc., and we would forward that money on to you. So there's some flexibility around when you leave. Next question. Why are the Islamic Sharia compliant funds typically more expensive? Asad, could you answer this, please?
Yeah, sure. Thanks, Daniel. So with the Sharia compliant funds, there's usually some additional costs associated with things like needing to appoint a Sharia board, for example, just to ensure that the fund is performing in line with the Sharia guidelines. Scale is also usually a factor. So typically Sharia funds will be smaller in size than some of the conventional counterparts that we have within the plan. And that can also make them a little bit more expensive. And then in terms of the actual running of the fund, there's some additional factors. There's things like purification costs. The fund managers need to hold some of the assets in cash for liquidity purposes. And all of those kind of factors can have a small impact on performance and tracking errors.
Okay, thank you. Next question. How long should I stay invested and why does it matter? Nora, could you take this, please?
So we would generally recommend, to look at, for each member to look at your own investment horizon and determine, I suppose, which option makes sense based on your investment horizon. Given the plan membership profile, most of the options available are growth oriented. So typically that would be a 5+ year holding term. But there are options available for members with a shorter horizon as well. So say, for example, cash, which would be much shorter horizon.
Okay, thank you. What are the fees and how are they deducted? I guess one for you, Chris, please.
Yeah, no problem. Thanks, Daniel. So the fees for DEWS are broken down into 2 main elements. So there's the element for the providers. So that's the Mercer, Equium and Zurich fees, and they come to a total of 1.23% per annum. And then the other element is the investment management fees, and that's the fees for the people that are running the investments, and that's dependent on the individual investment option or options that you're invested in, and they range from 0.03% to 0.65%. So if you took the default fund as an example, that total fee comes in is at 1.39%, which is broken down as 1.23% for the providers and 0.16% for the investment management fee. In terms of how the fees are deducted, they're taken from the performance on a daily prorated basis. So when you look at the overall balance of your account through your app or through your portal, it's net of all fees, so that they're deducted daily, and it's through the performance of the investment.
Okay, thank you. Next question: can I make my own personal contributions? I'll answer this one. Yes, of course, by way of voluntary contributions. To facilitate this, it would be filling in a form and submitting that to your HR or payroll provider. The way it works is by a salary deduction. We can't accept external monies because we run AML checks, etc., on the company, not on the individual. So we have to know the source of that money. But for example, the way that would work is for your salary is 20,000 dirhams. You want to contribute, for example, 2,000 dirhams. Your HR or payroll provider would forward the 2,000 dirhams into your DEWS plan, and you would receive the remaining 18,000 as a salary. We are looking to digitize this entire process within the coming weeks. We will, of course, have communication about that shortly. It's a very exciting progress for us, so we'll keep you posted. Thank you. The next question: how do geopolitical events affect the market and investment performance? Could I ask that to Julius, please?
They certainly do, but usually in the very short term. And over the last, well, really 100 years of market data, geopolitics shocks the market. But if you look 3 to 4 months after the event, the markets generally have returned to where they were before. So the markets tend to have a fairly short memory when it comes to geopolitics, and for better or worse, they tend to forget or fade it after a fairly short period of time. So from an asset allocation perspective, dynamically, it's almost impossible to catch it. It's impossible to call it. But strategically, over the long term, you run a diversified portfolio that helps you weather any storms that geopolitics create. And that was the best decision that you could have taken historically. And we believe going forward, running a well-diversified asset base to go through the weathers, through the storms of geopolitics is the best idea going forward.
Thank you. Next question: how can I understand the risks of the plan's investment options? Assad, could you take this, please?
Sure. Thanks, Daniel. In terms of risks, there's a wide range of resources that are available to you. I think the starting point I would recommend is to have a read through the investment guide, which includes a risk meter and risk ratings for each of the investment options. In addition to that, you also have access to key information documents for all of the funds. And those include also risk indicators, and they also include performance scenarios. So for those of you that are interested, you can have a look at illustrations of performance scenarios during different types of market environments. So if you look in those key information documents, you'll see scenarios for unfavorable market environments, moderate, favorable environments. And there's also a stress scenario, which illustrates what you might get back in extreme circumstances. So I'd encourage you to have a look at all of those resources to try and better understand the risks within the investment options.
Thank you. Next question, I think, again, is for you, Assad. How are the funds monitored?
Sure. The funds are monitored in multiple different ways. Part of the MERS's role is to actually research, rate, and monitor the underlying fund managers. We recommend managers with strong prospects of achieving their investment objectives. Our researchers conduct thorough due diligence on all of the underlying managers. We have a robust process. It's not based purely on past performance, which isn't necessarily a good indicator of future performance. We also look at a range of other factors like the idea generation, portfolio construction, implementation, risk management, fees of the underlying funds. We look at all of those factors in making a decision around the ratings of those funds. And then in addition to Mercer's oversight, there's also additional governance layers from the trustee and the supervisory board. So the trustee regularly reviews the suitability of the fund range, and they can also make changes to the fund range from time to time whenever they deem that to be appropriate.
Okay, thank you. The next question, in a high inflationary period, which investment opportunities are best suited to these circumstances? That be for Nora?
So I suppose in high inflation, you probably look to have a fund which looks to try and outperform that. So a growth focused option. We did, within the multi-asset options, look to add in inflation protection within the strategic asset allocation as well, as part of one of our recent strategic asset allocation reviews. So adding allocations to things like gold and inflation-linked bonds, and basically to further diversify the portfolios and increase resilience in inflationary environments. So that has proved very beneficial in the last couple of years. But really, I suppose, focus towards the growth options. So a fund that's going to generate a return ahead of inflation over the long term.
Okay, thank you. Next question. Is it possible to get higher allocation to private equity in the current program? Asad, could you answer that, please?
Yeah, sure. Thanks, Daniel. Private equity is challenging for a plan of this nature, simply because all of the funds that exist currently are daily dealing funds. So members can switch in and out of the funds on a daily basis. So they need to be liquid daily dealing funds. We have seen globally that DC plans do factor in allocations to private assets in some cases, and that's something that we're always looking into, and it might be something that's developed over time. But just in terms of the administration factors, platform factors, private market allocations within a plan of this nature can be challenging.
Okay. Thank you. Next question. For those who invest in Sharia compliant products, how can we have exposure to AI and /commodities?
Sure, I can try and answer that. So, for example, one of the Islamic equity options that's available within the plan is an index tracking option, which it automatically gives you exposure to a lot of these growth trends. In fact, it has a lot of exposure to the US and the technology sector in particular. So you might have noticed from Nora's earlier performance slide that the Islamic equity option has actually been one of the best performing options over the past year. And that ties into some of the comments that Julius was making as well around the strength of the technology sector and the US over 2023. And that's automatically reflected in the HSBC Islamic Global Equity Strategy. We don't offer specific themed strategies for people to choose from. So for example, we don't have a specific tech fund or a specific AI fund, but you do have exposure to some of those themes through the existing investment options.
Thank you. Question here, how can I make direct contributions beyond the ones made by the employer? I think I'll answer that. It was on my previous question really around voluntary contributions. We can only accept monies coming through the employer, not external monies, i.e. I have some money in my bank account I would like to transfer in. It has to come by way of the employer.
Sorry, Daniel, if I can just jump on that as well. There's
Sure.
A couple of questions around continuing to contribute once you've left employment. So just to clarify on the point that you've just made there around accepting direct contributions and around the contribution subject. Once you've left employment, we can't accept any further contributions as well. So you can't then use it as a personal account. However, your money can remain invested, the charges remain the same, and then you can access the money as and when you need to. But we can't accept any contributions once you've left your employer.
Just a quick one, Chris. How are we looking for time for more questions? Are we still good?
Yeah, I think we were meant to end 6 minutes ago. There's still questions there. I think maybe if we pick maybe one more out, and then what we'll aim to do is follow up with the recording of the session, and we can deliver a summary of the question and answers, and hopefully try and tidy up. And then again, for anybody that's got any questions that haven't been answered, please, contact us, drop an email through to dews.support@zurich.com. that's on the email there, and we'll aim to answer your questions.
Sure. I've got a question here. What about the tax on the dividends and the final earnings, assuming these are applicable to most of the portfolio assets?
Sorry, could you repeat that, Daniel?
Yeah, what about the tax on the dividends and the final earnings, assuming these are applicable to most of the portfolio assets?
Yeah, so we as the investment advisors to the trustee, we can't offer any kind of tax advice to individual investors. But tax is factored into when the fund managers are deciding what assets to invest in and what regions to invest in. They take into account of all of the various factors that might impact performance, and the fund managers will appropriately invest in areas that they think will add value in that way.
Okay, thank you.
Okay, I think at that point then, if we call or bring the call to a close, appreciate there are some questions in the Q&A that we haven't been able to get to, unfortunately. But as I said, what we'll aim to do is bring those together, get some answers to those questions, and then send out a communication as a follow-up, which will include the recording. I'd just like to express my thanks and everybody that's been able to facilitate the call today. Their thanks for everybody joining. I think it's always important to take opportunity to understand the investment market, the outlook, how the funds are performing, and the options that are available. We really do appreciate your feedback, and I think from there we'll say thanks and call the call to a close. So thank you very much.
Thank you.
Thank you.